The financial information provided in this content is for informational purposes only and not for the purpose of providing specific financial advice. Please contact a financial professional to obtain specific financial advice.
Do you remember Polaroid cameras? If you're about my age or older, then you probably said, "Ah, yes," and a memory popped into your head of someone taking pictures at a birthday party or family gathering with their Polaroid. For me, it was my grandpa. But if you're a bit younger than me, you probably said, "What do you mean remember Polaroid cameras? I just saw some on the shelf at Walmart the other day." Polaroid cameras took the world by storm when they first appeared after World War II. Their self-developing film and instant photos amounted to social media before today's social media age, and Polaroid cameras were popular with ordinary folks and famous artists alike. The SX70, released in 1972 and featuring photos that automatically ejected out its front, is one of the iconic consumer products of the 20th century. But the company failed to innovate and keep up with changing digital technology. It declared bankruptcy first in 2001, then a second time in 2008, at which point it stopped making cameras and self-developing film. But that year, a Dutch company called the Impossible Project started up to produce materials for Polaroid cameras. In 2017, it bought and began using the Polaroid name, and soon after introduced its own cameras and self-developing film under the Polaroid brand. And it's been quite successful. I think that Impossible Project is itself a pretty good name for a company. So why did Impossible Project buy and use the Polaroid brand instead? Before I answer that, let's look at an even more extreme example. In 2010, an entrepreneur named Tom Kartsotis supposedly paid $1 million for the Shinola name. Shinola was a brand of shoe polish founded in Rochester, New York in 1877. By the time Kartsotis expressed interest, the only place you could find the name Shinola was in a put-down suggesting that a person couldn't tell the difference between shoe polish and, well, other brown stuff. Kartsotis was among those who had been behind the highly successful Fossil brand of fashion watches. Now he applied the Shinola name to a new company that would build luxury watches, in Detroit of all places. Adweek called it the coolest brand in America, and the company reported $100 million worth of sales in 2015. But how do you go from Shinola shoe polish to Shinola luxury watches, and why? In both cases, entrepreneurs understood the power and the value of brand names. If a brand is in the public's consciousness, it potentially has the power to attract people to the products that carry the name. A brand generates value by attracting sales and increasing profits. Because of this, a brand is a store of value, and that makes it an asset. It's a special type of asset, though. We usually think of a company's assets in terms of buildings, offices, factories, and machines. But a brand isn't a physical asset like the ones I've just mentioned. Sure, a brand usually has a physical manifestation, like a logo. But it's much more than that. It embodies the company's reputation for quality, innovation, or trendiness, or maybe all that and more. Ultimately, a brand is an idea, or really a set of ideas. These ideas are as real as a camera might be, but they're not tangible in the same way. We understand brands, but we can't touch or see them. When Impossible Project revived the Polaroid, it was really reviving a concept, a reputation, a distinctive experience that millions of customers intuitively understood. In finance, we call brands an intangible asset. They're real, but they have no truly physical presence. Still, intangible assets are everywhere in our economy, and they've become the leading source of value for private companies. In turn, these assets generate most of the cash flows that ultimately reward present-day stock and bondholders. So the market for intangible assets is not some theoretical exercise, it's really a major driver of financial markets and investment decisions. And brands aren't the only intangible assets that matter to companies and investors. There are many kinds of intangible assets, and they create revenue and profits for companies just like physical assets do. In this lecture, we're going to take a deeper dive into intangible assets and how they create value for companies. If you want to be a successful investor, you'll probably want to understand intangible assets and how to evaluate them. Because as we'll learn, intangible assets can be tremendous sources of value, but they're also big sources of risk. Now let's step back for a moment to take in the big picture. To really understand intangible assets, we need to talk about how companies create value. Once we do, we can show how intangible assets contribute to this process. So what does it mean to create value? Sure, it's about profits. All companies want to earn profits. But not all profitable companies create value. In finance, value is created when companies earn higher profits than their competitors do. They're literally earning more profit than the market thinks they should, given the business that they're in and the nature and amount of risk that they're taking on. There's a concept in microeconomics called normal profit. Normal profit is the average profit earned by companies in a particular line of business. So it's really the expected amount of profit a company should earn from doing that business. And that's the benchmark for value creation in finance. If you earn profits that are equal to the normal profits in your industry, you're doing fine, but you're simply keeping up with the Joneses. You're not creating extra returns that can go to the owners of the business and make them better off than the owners of any other business in the industry. In short, you're not creating value. But if you're earning profits that are greater than the average, you're doing better than your competitors. Your owners are getting higher returns than they get from investing in the other players in the market. You're creating value. During the 1960s and 1970s, Polaroid was part of an informal group of companies known as the Nifty 50. These companies all had a reputation for solid earnings growth and above-average market performance. In other words, reliable creators of value for their investors. And if you're earning lower profits than average in your line of business, I'm sorry, but you're destroying value. You're not necessarily going bankrupt, but your investors are losing ground relative to investors in other companies whose profits are average or higher than average. So the question every company faces is, how are you going to deliver higher than average profits and create value for your investors? There's really only one answer to that. You have to find some kind of edge on the revenue side or the cost side that other companies can't replicate. On the revenue side, that edge boils down to market power, the ability to charge premium prices to your customers. And intangible assets can give you that ability. Let's start with an obvious example, a patent. A patent is an intangible asset that gives its holder the exclusive right to produce a particular product, such as a computer chip or a medicine. Patents create monopolies for finite but still considerable periods of time when the patent holder can charge high prices for that protected product. And the price differential can be huge. For example, in 2012, the pharmaceutical company Gilead Sciences, Inc. received FDA approval for the sale of Truvada, an antiretroviral medication that's highly effective in preventing the transmission of HIV and thus preventing AIDS. This was a game changer for millions of people in at-risk communities, and patent protection prevented others from producing the drug, allowing Gilead to charge thousands of dollars per month for the drug and causing its revenues to more than triple in the first 3 years of its release. Though Truvada's patent protection expired in 2020, it released a new and improved patented formulation called Descovy in 2016, which it continued to successfully market as an alternative. But patents are just one way for companies to create pricing power. Let's go back to our example of brands as another important intangible asset. How do brands create value? They create loyalty among consumers that enables businesses to charge higher prices over long periods of time. For example, think about the restaurant chain Chipotle. There are literally tens of thousands of taco stands, food trucks, and restaurants in America where you can get a burrito. But Chipotle offers a standardized product and a standardized experience that people like and know they can count on. When many people want a burrito, they'll choose Chipotle, even though there might be other places on the same block with better burritos. Some consumers choose the dependability and quality associated with the Chipotle brand over those other places and are willing to pay a premium price. That combination of repeat customers and premium prices leads to higher than normal profits and value creation for the Chipotle brand. Technologies that can't necessarily be protected by patents are often a big part of intangible assets. Think about the success of Apple. It has lots of patents, but one main source of brand value is the company's ability to make its technology user-friendly, stylish, and intuitive. It also works hard at making its products work well with one another without much user effort. If you buy an iPhone, chances are you'll eventually end up buying an iPad or a MacBook or AirPods because they work so well with each other. Apple technology attracts customers and gets them to pay premium prices for its products. It also keeps customers locked in by making it inconvenient to change over to a competitor's products. Ever tried to move all your contacts from an iPhone to an Android phone? There's nothing preventing other companies like Samsung from using their technology in similar ways, and of course they do try. But they don't do it quite as well as Apple does. And so for Apple, their use of technology to enhance their users' experience is a very valuable intangible. Their business strategy of creating a so-called walled garden is also a valuable intangible asset. Apple maintains control over what software can be used on its products and what hardware is compatible. So that means to access the millions of Apple customers, an outside company must work with Apple and usually pay them to get in the garden. Individual product attributes, some of which are protected by trade secrets, are also an important type of intangible asset. For example, I drink a lot of diet soda, but my far and away favorite is Diet Dr. Pepper. There are a lot of knockoffs, but to me, only Diet Dr. Pepper tastes right, and I'll buy that over other diet sodas if I have the chance. Like Coca-Cola, Dr. Pepper has a secret recipe that is one of its most valuable intangible assets. Attributes like a distinctive taste are in turn a foundation on which a company can build a successful brand. And there are all kinds of product attributes that become intangible assets. Something as simple as a swoosh symbol or 3 stripes on the side of a sneaker become important style elements that distinguish a product, create loyalty, and premium pricing that in turn create value. I don't even have to name the companies associated with these trademarks, right? Let's turn to the cost side for a moment to complete the picture of how intangibles create value. The game here is to find ways that reduce costs that nobody else can think of or replicate. For example, it's well known that nobody does logistics like Walmart does. That company has found ways to organize and operate its supply chain that are far cheaper than the methods used by its competitors. In fact, with most commoditized products, intangibles on the cost side are a key area where value is created or destroyed. For example, automobile companies are constantly looking for the best ways to organize their assembly lines and the right combinations of human workers and robots that lower their production costs below those of their competitors. That's increasingly the game in fast food, too. Starbucks has been working on a complete redesign of their store work areas to make it possible for their current staff to serve a much larger number of customers. Believe it or not, knowing the best place to put the Frappuccino blender is an important intangible asset. I've been talking about intangibles as if they're the next big thing, but in reality, intangible assets have always been around. Some brands are well over a century old now. The AT&T brand, one of the most valuable in the world, goes back to the dawn of the telephone age in 1885. Another global mega brand, IBM, started in 1911. And I'm sure that brands have been an important intangible asset for as long as there's been commerce. Prior to modern corporations, family names and sometimes place names carried those associations. For instance, think of the intangible reputations of the Rothschild family or the nation of Switzerland in banking. Similarly, for centuries, companies have been able to seek patent protection for their products. And technological innovation has always been fundamental to the development of an economy. So what's so different about intangibles now? Well, it's because they become the main type of asset in our present-day economy, and therefore the main asset that you're investing in when you buy the stocks or bonds of a business. There are 2 main reasons for this. First, the economy has evolved in ways that have increased the importance of intangible assets as sources of value. If you go back about a century and a half or longer, the main business of an economy was usually agriculture. Then, thanks to the Industrial Revolution, the main business became making stuff in factories. Sometime in the middle of the 20th century, economies started to produce services more than things. In the past couple of decades, that has given way to making ideas. In other words, the transition from the agrarian economy to the knowledge economy rests on intangible assets to deliver value. Every step in that evolution created businesses that depended more heavily on technology, brands, and ideas to produce the goods and services that people wanted. And the products people wanted were increasingly intangible. These days, we say that people desire interesting and unique experiences more than the latest fashions or the coolest electric car. Of course, people still want clothes and cars, but they also want to play virtual reality games and hear lectures from the best professors. The second reason for the rise of intangibles is globalization. Globalization broke down many barriers between economies and created larger markets. That didn't really change the demand or supply of intangible assets, but it significantly enhanced their value. The larger the markets, the more profits a company's intangible assets can generate. Moreover, the information revolution has allowed an ever greater penetration of brands, technologies, and ideas across the globe at unprecedented rates. Today, global brands are present and generate sales and profits virtually everywhere. Just about anywhere you go in the world, you can buy a can of Coca-Cola, hop on a Toyota, or find a McDonald's. And it's not just brands that benefit from larger markets. Other intangibles also gain value in a globalized economy. Take distribution networks. You might have a great product, but if you can't get it to people, you won't make any sales. When the American company Kraft Foods bought the British confectioner Cadbury back in 2010, the goal wasn't to sell more Cadbury chocolates to American consumers. It was to enable Kraft to use Cadbury's existing distribution network in India, which was on track to become the world's largest market by population. In other words, Kraft's goal was to sell food and snack products to a group it hadn't reached before. Just how valuable have intangibles become because of the evolution of the economy and the rise of globalization? Well, Ocean Tomo estimates that intangible assets account for about 90% of the S&P 500 company's total assets. We're talking over $21 trillion of value tied up in intangible assets. Now, I take this estimate with a grain of salt because it's tricky to assign value to intangible assets, and there are still large amounts of land, buildings, and machinery in the modern economy. But as the economy evolves, I might expect intangible assets to account for nearly all the value of a company's assets in the not-too-distant future. In certain industries, that transition has already occurred to some extent. For instance, many of the most valuable global fashion brands do not own factories at all, but rather outsource production of their clothes to a vast network of global clothing manufacturers. And with the decline of malls and rising popularity of online clothes shopping, many labels are also closing stores and moving increasingly to online retailing only. The value of their clothing, and thus their company, is derived almost entirely from their styles and designs, and the reputation of the label. All of this talk about the high and increasing value of intangible assets make these intangibles sound like a one-way bet. But there's no such thing as an asset that only goes up in value. Intangible assets have their own special weakness. They're fragile. What I mean by that is that intangible assets are surprisingly vulnerable to a loss of value. And like other fragile items such as glass, they can shatter, destroying all of their value in an instant. As an example, because intangible assets are based almost entirely on ideas, there's no guarantee that another company won't come along with a better one than yours. We've seen this play out over and over. Do you remember using Lotus 1-2-3 spreadsheets? Microsoft Office basically drove it and other Office productivity software out of the market. Web browsers like Netscape lost everything when new players entered their market. Shortly after that, the early winners in the internet economy, such as Yahoo, lost values when other companies like Google developed much better search engines. Much later, the short-format video app TikTok displaced Instagram, Snapchat, and Facebook as the main social media site for young people. Similarly, the rise of so-called fast fashion means that clothing trends and styles become dated quickly, and while some designs can remain iconic for long periods, most fashion labels must constantly reinvent themselves every season to maintain their value in the marketplace. Patent protection is no guarantee of permanent success either. When a pharmaceutical company patents a new medicine, it must disclose the structure of the compound to the public. This helps competitors invent similar drugs that aren't covered by the patent. Later, the pharmaceutical companies face so-called patent cliffs when the patents on their medicines expire and are exposed to competition from generic versions of their products. Creating new drugs eligible for new patents is a long and uncertain process, sometimes taking decades from first discovery to market approval. And a lot of drug research ultimately leads to a dead end, because a drug formulation isn't effective enough or is too dangerous. So pharmaceutical companies must invest billions in research and development, decades in advance, to turn up maybe just a handful of drugs they can expect to profit from. Another aspect that makes intangible assets fragile is that they're often based on reputation. As the saying goes, it takes a lifetime to build a good reputation, but you can lose it in a minute. Corporate scandals and social media both have the power to transform a reputation overnight. For example, the hip-hop artist Kanye West designed a successful line of clothing for Adidas, but when he made anti-Semitic remarks that damaged his reputation as an artist, this had potentially disastrous consequences for Adidas, which promptly severed the business relationship and forced the company into damage control, as well as to find a way to manage its huge inventory of now controversially branded shoes. Another example of a company that damaged its reputation and vaporized lots of market value comes from the electric vehicle startup Nikola Corporation. The company made a promotional video of its electric 18-wheeler truck rolling down a hill and looking great. But soon after the video was released, it came to light that the truck couldn't move on its own. The truck in the video was pushed to the top of that hill and then released, so that gravity was the real force moving it. Gravity took hold of the company's shares as well. Now we have a fuller picture of the opportunities and risks that intangible assets offer. What's fascinating to me is trying to figure out their net effect on the value of a company and on the market in general. I love to have my students in corporate finance debate this idea. On the one hand, intangible assets are sources of new profits and high growth. That's clearly good for value. But on the other hand, intangible assets are significantly riskier than tangible assets such as buildings and machines. Which of these effects is stronger in a particular company? That, to me, is an essential question for investors to grapple with anytime they consider buying a stock, a corporate bond, or any other financial instrument backed by the earning power of a company. In today's world, the ability of a company to deliver on its financial promises increasingly depends on the performance of its intangible assets. So, looking at standard financial numbers such as balance sheets, profit and loss statements, sales, and so on is still an important part of making investment decisions. But it's insufficient. We should also evaluate a firm's intangible assets to get the full picture of a company's value and future earning potential. How do we do that? Well, I would start by identifying the intangible assets that a company has. It could be something visible, like a strong brand, or it could be a reputation for quality products and excellent service. How innovative is the company's technology in terms of its current products or what we know about its future pipeline? What other aspects of a company's products attract customers and lock them in? And don't forget the cost side. Has the company found cheaper or more efficient ways to make, distribute, or invent its products? Does it minimize costly returns and employee turnover? Finding these intangibles might require some digging and reading between the lines of news stories and analyst reports. Whenever somebody praises a company for something, I ask myself, are they talking about an intangible asset? If so, what is it? Once you've identified a company's main intangible assets, then you need to assess them with as critical an eye as you can. A good way to do this is to ask how much this intangible stands out from the same asset of its competitor firms. Does it have a nationally known brand while its competitors are only locally or regionally known? Is the firm's technology years or only weeks ahead of the competition? I also focus on the competitive moat around the intangible. In other words, how difficult would it be for competitors to replicate this intangible, or even to go at one better? Would they have to find the way around a patent, or just update the software in their production lines? Do they have to get serious about improving the quality of their products, or just do a better job of advertising their quality? And finally, you should try to be as realistic as you can about the fragility of a company's intangibles. What would it mean for the company's main intangible asset to shatter and lose most of its value? How likely do you think that event is? And how much damage to the company's earning potential would this event cause? These questions can be especially tough to answer, not only because events like the Nikola video are difficult to predict, but also because the most serious wounds to a company's intangibles tend to be self-inflicted. It's hard to believe that a company you think highly of would be capable of harming itself like that. So we tend to downplay or ignore that possibility. So keep in mind that although intangible assets are here to stay, most individual intangibles aren't, due to the fact that intangible assets are based on ideas, and new ideas are always pushing old ones out of the way. Sometimes, though, old ideas can get a chance at a new life. Who knows? Maybe even Google will fall from grace someday, and its brand will come back as a name for shoe polish.